So again, today, what we're going to focus on is finishing up the valuation model of Parker Hannifin, doing what we're going to call an as-is valuation, so we get within $1 of their current share price. This will set us up for your next week's group assignment. Okay, so just two things. One, if you're able to finish where we end up today with the as-is model of Parker Hannifin, then you can submit the file. If not, you have to get to where we end up in class today by Monday at 10 a.m. as an individual assignment, submitting your Excel file. Okay. Now, today I'm also giving you your second group project assignment, which is going to be due Wednesday morning at 10 a.m., 1 week from today. Okay, and that's going to involve pretty extensive work, but you're going to do a valuation using this model on Boeing, doing an as-is model of that, following the process using the file that you just created. You'll also do an EIC on Boeing, and you'll do a write-up of an ROIC tree on Boeing. But you'll do that as a group, minimum 750-word paper, plus a group valuation file that you'll submit together that you'll work on collaboratively based on what we built in class today. So in order to prepare you for that second group project, we need to make sure that we get the model finished in class today. So post haste, I'm going to go ahead and get started. So this is where we left off in class on Monday. We had basically built a model that, based on these assumptions and these ratios, projected out 6 years of financial statements and then converted economic statements, including CFI for Parker Hannifin. So what we're going to do today is we're going to turn that into a valuation. So if you look at the series of tabs that go from left to right, we're going to add a tab at the end of our model. I'm supposed to, so drag it to the end, so that the last tab in our model is a tab called Valuation. And this is where we're going to actually build the valuation for Parker Hannifin and other companies. All right, I'm trying to put this here at the end. There we go. Okay, so here's the process that we're going to follow. It was talked about in your readings from the book this week, but we're basically going to follow Modigliani-Miller. So operating value plus non-operating value equals enterprise value, less debt equals equity value. Okay, so again, following the process in the book. So make this a little bit bigger so it's easier to see. And instead of going across the columns, I'm going to go down the rows just so that we could actually print this out on a one-page piece of paper, 8.5 by 11. Okay, so we'll start out with the operating value. Operating value is based on free cash flow. So starting in cell B1 on your new valuation tab, write the word free cash flow. And we're going to need to basically get the forecast for free cash flow from our model. Well, the nice thing is our first year, and I can drive this off of assumptions, is the last reported year plus 1 is the first forecasted year. And we're going to use 5 forecasted years of free cash flow as our defined period. So equals previous year plus 1. And I'm just going to copy that down 3 more years so that we have, ooh, what happened there? Copy, paste. So we basically have 5 forecast years, which we're now going to put in our free cash flow forecast. All right? So the free cash flow was actually forecasted off the CFI tab. So for the 2019 forecasted free cash flow, so in cell B2, equals, from the CFI tab, free cash flow is row 12, and the first forecast year was H, so H12 is the first forecasted year of free cash flow. Okay, now 2020 forecast for free cash flow off the CFI is I12. 2021 free cash flow is J12. 2022 free cash flow off the CFI is K12. And 2023 free cash flow off the CFI tab is L as in Larry 12. And I'm just going to format this to 2 decimal places, just to make it a little bit cleaner. Okay, so
2019 the assumption and the assumption tab. on the assumption did you just do?
I just did for 2019 assumptions B2 plus 1 because that's the first year.
And then did you just do assumption?
And then just plus 1 all the way down. Yeah. So again, I want to make the years a relative reference so that if we do have another year, so say it's 2019's last reported year, we change it once, the assumptions flows through the entire model. Okay, so we don't want to have hard-coded years. Okay, so we made everything's relative references. Okay, so assuming that our CFI is accurate, these would be the free cash flows for the first 5 years, or what we're calling the defined forecast period. So our next step is to present value this. Now, I like to say I'm old school, so when I was in your shoes at Wharton, we didn't even have Excel. It was back in the days of Lotus 123. But long story short, we were given sheets of paper with discount factors. We took our cash flow times discount factor to get present value. So you can go straight to the present value if you want, but basically, a discount factor, I'll write that in here, equals 1 divided by left paren 1 plus R, so 1 plus the discount rate, and the discount rate, the R that we're going to use, is on the Assumptions tab. It is our WACC. Okay, and if I make this an absolute reference to Assumptions B4, $B, $4, I can copy this down for the 5 years, and I'll start adjusting by year. So 1 divided by 1 plus R. Second year, 1 divided by 1 plus R squared. So at the end, shift 6 is the square function in Excel. 2, so that's the second power. For C4, 1 plus at the end, shift 6, 3, third power. 1 plus R to the fourth power for row 5 is shift 6, 4. And for 2023, shift 6, 5. All right. And let's clean this up a little bit. They get like 5 decimal places. But those are basically what are called discount factors. So we basically get a discounted, that's right, discounted free cash flow by taking our free cash flow times the discount factor, and that's the present value of the free cash flow. All right. And so if I copy this down, those are the 5-year free cash flows that are discounted back to a present value. All right. So if I were to sum these 5 years, I have the forecast of the operating value, in this case Parker Hannifin, for the first 5 years is the sum of those 5 items. So assuming our forecast is true, they're going to be worth about $3.8 billion present value of operating free cash flow value based on this first 5-year worth of forecast. Okay, so once I present value them, I just sum the present values, and that gets the initial operating value for the first 5 years. Now, the main difference between a project and a company is we assume companies last forever, so we have to forecast Parker Hannifin beyond the first 5 years. This gets into what's called the continuing value period, or CV, and this is where we use the concept of a perpetuity. Okay. And this is why we also did on Monday the idea of an N+1 forecast year, because the 6th year is what we're going to use to help us with the perpetuity period. Okay, and the growing perpetuity equation we're going to use is the McKinsey modified version, which is what they call the key value driver formula. We've already talked about it this semester, but it's also in this week's reading and therefore this week's lecture notes. Pop those up, lecture note 5. But it's basically, oh, here it is, already had it up. It's this formula. Continuing value, perpetuity, is no plat times 1 minus the G over ROIC divided by the WACC minus G. All right, we've already seen this formula. We've already used this formula. This is the reason we're using it, because this is what we're going to use to estimate continuing value. The formula has 4 parts to it. We need to know a continuing value no plat as a starting point. That's going to be our year 6 no plat. We're going to need to know a continuing value ROIC. That's going to be our year 6 ROIC. We're going to need to know a continuing value WACC, and we're going to need to know a continuing value G. Those are the 4 elements to complete the continuing value formula. Now, here's what I'm going to do. This is where the Assumptions tab will also come in. So in our model that we're building, rather than doing, this is now the continuing, I'll write this out, the continuing value of Parker Hannifin is the key value driver formula. So rather than putting all the formula here and all the assumptions scattered throughout our model, I'm going to go to the Assumptions tab, and I'm going to aggregate those 4 assumptions in one place. We already have the WACC. Okay, so I need the other 3 parts of the formula. So I'm going to need a continuing value NOPLAT. I'm going to need a continuing value ROIC, and I'm going to need a continuing value G. Those are the other things besides the WACC that I need to complete the continuing value formula. Now, the continuing value NOPLAT, I'm going to get B5 here equals, off of my TII, we have a forecast for NOPLAT. That is row 4, and the final year continuing value period, 2024 NOPLAT is M4, 3315.4. Okay, 2 decimal places to make it a little cleaner. All right, so that is the continuing value NOPLAT for Parker Hannifin, right, based on a forecast in our model. Now, here's the thing. What it should be is representative, okay? And hopefully that the year 6 is representative of the beginning of the perpetuity formula. The challenge becomes, if we're dealing with a cyclical business, what if we're in a horrible recession and year 6 is at the bottom of the trough? Well, that NOPLAT is probably not representative of the firm long term, and will probably undervalue the firm. Same thing, if we're in a cyclical business, and what if year 6 is the peak of the peak? Well, it's going to probably overvalue the firm because that's not representative of the long term. So what I'm going to also do is I'm going to make this cell yellow. This is part of the reason why I put it in the Assumptions tab, because sometimes we'll have to use common sense to override some of the raw data we're putting in here. And every now and then we might put in something that we think is a more representative NOPLAT than just the arbitrary year 6 NOPLAT. But most of the time, hopefully year 6 is representative. But that's why I'm going to make it yellow, because we could potentially change it. Same thing with ROIC. We need a long-term ROIC that represents the future of the business. So again, for our continuing value ROIC equals, off of the end of year ROIC, EPEOI, I want to use ROIC, which is row 15, because we do it after goodwill, and the continuing value is 2024, so M15, or about 18.1%, is our continuing value ROIC. I'll make that percent to 1 decimal place, and again, yellow, because that's something I could potentially overwrite, but at least that's our continuing value NOPLAT. And then the final assumption is our G, and I'm going to start with 3%. Now, I'll make this yellow as well, because that's something we can change, but this represents the growth into perpetuity of the firm, of their free cash flow and constant margins, proxy revenue. So here's the deal. For the last 100 years, U.S. GDP has grown up about 3% a year. So the idea is that eventually a company like Parker Hannifin should probably grow GDP of the countries that they're in. Now, some argue 3% for the next 100 years is too high. So maybe 3% is not the number we'd use. We'll start this as a placeholder. And later, I'll give you some more tools to help you better estimate a G for a company. But for now, we're just going to leave 3% as a placeholder. All right, so now that we have the 4 assumptions of the key value driver formula, we're going to go back to our Valuation tab. And in cell B9, we're basically going to put this formula with the right order of operations into this cell. Okay, toughest thing you got to do all day. So equals left paren. Go back to the Assumptions tab. NOPLAT. So B5 times left paren 1 minus the growth, so B7 divided by the ROIC, B6, right paren, divided by left paren, the WACC, B4, minus the growth, B7, right paren, enter, about 55 billion. So assuming, and I'll leave this up here, I'm trying to replicate the formula, but assuming that our assumptions for continuing value come true, then Parker Hannifin's going to generate about $55 billion worth of value in the continuing value period. Now that is as of the beginning of year 6. Okay, it's not a present value today, so we present valued it to the beginning of year 6 based on the perpetuity. So now we have to present value that number to today, and we're going to use the same discount rate as we did for 2023, because the beginning of year 6 is the same as the end of year 5. okay, for all practical purposes. And by the way, this is a common error. We don't want to double discount this year because the growing perpetuity equation essentially discounts. So year 6 has already been discounted as part of B9. So we don't want to discount that year again, which is why we're using last year's discount rate. Okay, so basically in present value, we take B9 times C9, and we're going to say 37.7 billion, using some rounding here, 37.658 billion of value today, year 6 into perpetuity. So the overall operating value that we are forecasting for Parker Hannifin is the 3.8 billion in the first 5 years, plus the 37.6 billion into perpetuity, or approximately $41.479 billion. That is the operating value of the free cash flows, assuming that our free cash flow formula is correct in terms of our assumptions. Questions? Everybody with me on this so far? Yes. Questions? So far, so good? Okay, so again, following Modigliani-Miller, operating value plus non-operating value equals enterprise value. So now we have to do the non-operating value of Parker Hannifin. Here is where TFI helps us, because on our TFI, we've already arranged all the twos, the non-operating assets and liabilities together. Okay, so what we're going to do is we're going to basically list the 3 items off the TFI that are non-operating, starting with row A13. We're going to go refer to the TFI, and we're going to go to A9, which is excess cash, A10, non-operating assets, net of non-operating liabilities, and A11, long-term investments. So I'll just take that, be lazy, copy it down too. But those are the 3 non-operating lines that are on our TFI. And those we have to value. Now here's the thing. Cash is cash. So basically, as far as excess cash is concerned, the last reported cash of Parker Hannifin on their balance sheet is the cash that I'm going to use. So for each of these items, we're going to use the last reported year, which for them was 2018. So that was column G. So starting with G9, G10, and G11, these are the 3 non-operating assets and liabilities that we would have to value. And again, they are already in present value. So 569, 98, and 0. Okay, so if I add these up, I get my non-operating value, which is really the sum of these 3 things, of 666.81 million. Okay? Now, little detour. These are numbers straight off the balance sheet. So cash makes sense. Whatever the cash is already in a present value. You don't have to worry about that. Cash is cash. All right? Non-operating assets, non-operating liabilities. My assumption is that the accounts are going to do a good job. These were reported at book value. The values are probably not all that different than book value. If they were lower, the accounts would have written them down. So this is probably pretty accurate to the real value of the non-operating assets and non-operating liabilities. The one item that might be different than what's on the reported balance sheet are long-term investments. If I make a minority investment into another company that's publicly traded, I list it at book value. But if that value is much higher, I don't mark to market. All right, non-financial firms don't mark to market long-term investments. They keep it at book value. So I know that this is kind of a floor, but it may not be the true representation of what it's worth. So for example, a number of years ago, Microsoft bought a piece of Facebook before Facebook went public. Well, you can do the math on how valuable that is today. It was a great investment for Microsoft on many fronts, but here's the point. On Microsoft's balance sheet, it's $1 billion. Okay, Facebook's worth far more than, I think they gave them a $15 billion valuation when they did that valuation. They're worth far more than that today. So that wouldn't be a realistic valuation of $1 billion if they had held it all that time. So the accounts can't mark that to market, but we can make an adjustment here in our model. So here's how we're going to do this. This doesn't happen a lot, but if you ever need to, on the Assumptions tab, we're going to put in row 8, the price to book multiple of long-term investments. And right now, I'm just going to leave it at 1, yellow, 2 decimal places. And here's what I'm going to do. I'm going to take my long-term investments off the balance sheet, TFI G11, and I'm going to multiply that by assumptions B8. So since the multiple is 1, price to book 1, it basically says book value. Whatever the value is, leave it alone. And we're going to leave that for the most part. But let's say it's worth 20 times what we paid for it. Change the multiple to 20, and then it'll adjust the model to a more realistic market value. So again, if you don't know the market value, at least you have a book value in there. But if you do know a market value that's far different, it at least gives us an ability to make an adjustment for that. That's really what the price to book multiple is about. All right, for now, just leave it at 1. We'll leave it alone for Parker Hannifin because they're at 0 anyways, so it's not going to really affect their valuation. This is just setting it up for the reusable model. Okay, all right, so here's the point. Back to Modigliani Miller. Operating value plus non-operating value equals enterprise value. So our next step is enterprise value. We take the 41,479 and change, D11, and we add in the 666.81, D17, and we get a forecasted enterprise value of 42,146,000,000 and change. Okay, so very quickly, we've just forecasted, based on our CFIs, the enterprise value for Parker Hannifin, assuming all of our forecasts come true. All right. Now, to get to an equity value, we have to pay off all of the debt and the non-common shareholders. Again, this is where TFI helps us. So starting in row 21, if I go back to my TFI, to get to an equity value, we'd have to pay off the retirement-related liabilities, the interest-bearing debt, the preferred shareholders, and the minority shareholders. Those 4 stakeholders would have to be paid before the common equity holders would get their money. So let's start paying them off. Retirement-related liabilities. Okay, next row down, interest-bearing debt. Now, we don't want to double count the common because we're solving for common, but the next one is the preferred shareholders. And the final one is the minority shareholders. So those 4 stakeholders have to be paid before common gets their money. So what do we owe the retirement-related liabilities as of today? Well, again, off the TFI, last reported year is 2018. So for D21 equals TFI, 2018 is column G, so G14. G15 is interest-bearing debt. Off of TFI, G17 is preferred stock, and G18 is minority interest. So, and I'll make these all 2 decimal places, but nonetheless, these are the 4 stakeholders that have to be paid off to get to common equity value. So, if I take my enterprise value and I subtract the sum of these 4 items, I basically get a common equity value of approximately 36 billion. So the last 2 items I need are my shares outstanding. Spell that right. I need a share count today, because if I divide that by the shares outstanding, I would basically get a forecasted share price. So here's one of the screens as you do valuations that you'll need out of Bloomberg to get the shares outstanding. All right? It is called DES. So if you go to Bloomberg and you go to Parker Hannifin, on my mail here, PH US Equity, and you go to DES, which stands for Security Description, very handy. On the screen is the shares outstanding, right there, 132.4 million. Just an easy way in Bloomberg to get a current share count for a firm. By the way, you will take a screenshot of this screen by coming up here in this little triangle, or this square, take screenshot, save. Now, the format that I have used is ticker symbol, PH dash screen name, DES. Okay, so you will see in Elms, under the Files section, in PH Model, I've already taken 3 screenshots today for the 3 screens that we're going to need to get the data out of Bloomberg. So one is PHDES. We're going to need one for EEO. We're going to need one for WAC. So this is your roadmap for what you're going to have to get when you reuse this model, particularly for next week's assignment. Okay? But nonetheless, this is where you get your share count. But here's the deal. I don't want to put this share count into this field because it's a scattered assumption that I'll forget about. So what I'm going to do is I'm going to go to the Assumptions tab, and row 9, shares outstanding. I'll make this yellow, equals, from the Valuation tab, whatever that, sorry, go the other way around. I'm going to, for the Valuation tab, equal that one. The share count was 132.4, so go ahead and type in 132.4. And on my Valuation tab, I am going to refer to that share count, because what will be very frustrating is if you're doing your next assignment, which is Boeing, and you don't change the share count, you'll have a hard time getting the share price, okay? And you'll forget about it. That's why we're putting these things in the Assumptions tabs, which is very clear the things that we're going to have to update in our model. Okay, so given this, if I take the common equity value and I divide by the shares outstanding, model share price $271.95 per share. Okay, so very quickly, what we've done is we've taken our cash flow forecast and we've turned it into a valuation, specifically an enterprise DCF valuation, giving us a forecasted share price, $271.95. Okay, questions about how we got here? Yes, sir.
Are we going to need to go on Bloomberg and take screenshots and upload them, or is that just relevance?
For your next assignment and going forward, yes, you will have to go to Bloomberg and take screenshots. This one, I'm giving you the screenshots so you have your roadmap. But for the next assignment, for example, Boeing, which is the group project that you're going to all work on next week, then you'll need screenshots for Boeing. So at least you'll know what to get for the Boeing screenshots. And for your group project, I'm going to ask you to turn in those screenshots just to make sure you're taking the right screenshots and looking at the right data. All right? Because a common mistake will be, for example, with EEO, you get quarterly data rather than annual data. Well, that will completely screw up your valuation. All right, easy to do, so you got to be careful. You know, or the other thing is when we do the valuation, I need to know what price you're valuing at. The nice thing about the DES screenshot at the top of that page is the current share price. So it's as of that day, that share price, that we're going to judge you, because obviously Boeing stock price could bounce around day by day. Okay. So again, these screenshots will also help us and help you. Okay, but that's your roadmap. Other questions? Okay, so our next step, and this is part of your current homework that you're going to have to turn in at the end of today, is to do what's called an as-is valuation of Parker-Hannifin. This is something that's not commonly done. It's something I'm going to make you do in this class, and you're going to quickly realize the benefits of doing it because most people skip this. Most people, when they do a valuation, go right to the target share price. Here's what I think they're worth. But you will find value if you basically take the current share price and you back into it. So the idea of an as-is valuation is take the observed share price of the company, which right now is approximately $186 a share, and basically put in assumptions in our model that get $186 a share, or as a standard, within $1. Okay, as close as you can. Because here's the point. It's not whether you agree with it. I don't have to agree that this is the right share price. But what I want to know is what assumptions did the analysts that are valuing them have to use to get that share price? So what growth rates, what margins, what cash flows, what discount rate get to me that share price? And that's very valuable because then when you start putting in your opinion, you can also baseline against what the market is using. So that's the point of the as is. So at a minimum, you will do 2 valuations, right? And actually, you're going to start doing 4 valuations, right? So the first 2 is you're going to do an as is and then a target, okay? What you think is your target, as is based on observed data. Eventually, not for next week's assignment, you're also going to do what's called a bull and a bear. So you're also going to give me the range. How high can this thing go? How low can this thing go, regardless of my target? So I want to understand the risk profile I'm taking when I get into a stock. Okay, so that's eventually where we're going. You'll eventually do 4 valuation files, but right now we're just going to start with 1, which is called the as is. All right, so how do we do this? Well, let's go back to our model. So the next thing I need to do as I get close to this is I need to know what I'm getting close to. So back to assumptions. So next assumption, and I'm going to put a space in here, but I need to know my current share price of the company, which is yellow, and then I need to know my model share price. My model share price is pretty simple. I'm just going to refer to Excel auth evaluation D30. So that's what the model's doing. And the current share price of the company is the observed share price. Now, I am going to do one minor pivot because this is the second section of the day, and I just want to be consistent across the sections. I took a screenshot of the share price for the 11 a.m. section. Okay, so just so we're all using the same data, all right, this is the screenshot that was uploaded to Bloomberg, but about an hour ago, their share price was $185.85. Okay, so that's the price I'm going to use. Hasn't changed that much, but just so we have consistency across all my sections, I'm going to use this share price, $185.85. All right, so here's the point of the as is. What we're about to try to do is to get these 2 numbers very close together. I want my model to get within $1 of $185.85. Okay, that's the process that we're about to do. And so in order to do that, I'm going to change some assumptions, and then I'm going to change some ratios. So when I jump to the ratio screen, I'm also going to make my life easy. I'm going to unhide some of these previously hidden columns. And because I don't want to keep jumping, it gets lazy and time consuming, what I'm going to do, starting in cell F23 equals the current and model share price. So same thing, as I'm jumping back and forth, I can quickly, I don't have to jump back and forth, I can quickly see what the share prices are. So for example, if I change any of these numbers, I can immediately see where I am versus where I want to be. So it just makes my life a little bit easier. Constantly have to switch tabs. Okay, so just putting that reference there. Okay, so here's the thing. What's going to matter most to the valuation is the forecast of free cash flow. It's the operating value of the firm. Okay, and there's 2 parts to free cash flow. There's gross cash flow and there's gross investment. If you think about gross cash flow is a function of your NOPLAT, so it's your pre-tax profit times tax rate, and to get our NOPLAT, pre-tax profit, or basically EBIT, it's going to be driven by how fast revenue is growing at what margin. So if you think about it, forecasting gross cash flow, 3 things are going to matter. What's my growth rate? What's my margin on every dollar that I sell? And we're using EBITDA margin. And what tax rate am I going to pay? Those are the 3 drivers of NOPLAT. And that is going to be 90% of your valuation right here. It's figuring out what the right 3 drivers are to put in there. Now here's where this part of the model helps us out. If you remember on Monday, I said we're going to have all the balance sheet items as a percentage of revenue. So as revenue grows, the balance sheet grows. That basically creates for us the concept of gross investment. So we don't have to forecast gross investment. The model will create the gross investment for us for the free cash flow, because as the revenue grows, the balance sheet will grow, and it can back solve for what that gross investment needs to be. So again, for simplicity, as long as the company's productivity doesn't change dramatically, and we can always change these assumptions, but basically the company will essentially forecast the gross investment for us, as the revenue grows. So it just made our lives a little bit simpler. And that allows us to focus on what really drives value, these 3 items. Okay? The other 2 items that are going to matter are G and WAC. Okay? So let's start out with WAC. So right now we have a placeholder for WAC. I'll make it a couple more decimal places of 8%, which is arbitrary. So here's what we're going to do. We're going to go to Parker Hannifin, and we're going to type in WACC, and this is Bloomberg's estimate of their WAC today. So based on 81% equity and 19% debt, basically Bloomberg's estimating 10.4% for the WAC. So we're going to put 10.4 as the WAC. Notice when we did that, share price just dropped to 158. Okay? Higher discount rate, lower value. Now, next what we're going to do is we're going to go to ratios and we're going to look at the tax rate. Obviously, given the big corporate tax cut that was had, 37.7% is probably too high for a tax rate going forward. So, to find the tax rate, because the analysts are looking for this too, any quarterly conference call, the analysts trying to figure out what the tax rate are going to ask the CFO. They're going to say, what tax rate are you using going forward? Companies will generally give guidance. So one place you can find tax rates is in Bloomberg. If you go to EVT, I assume they gave you this in the training, these are all the quarterly calls and industry conferences that they're in. And one very cool feature of Bloomberg is you can take the last quarterly call, and by the way, it'll also give you the PIN number. So if you feel really brave and you want to listen to somebody's quarterly call and be unmuted, right before the call, go to Bloomberg, you can get the PIN to be unmuted. Okay, it's kind of dangerous, but nonetheless, this is where they put it. So back to this, as part of the call, they record the call, so that's an audio of the last quarterly call for Parker Hannifin. They have the PowerPoint that management gave, and more importantly, there's a transcript. So Bloomberg is listening in on all the quarterly calls and in real time transcribing them. Right? It's a computer doing it, not a human, but they're basically creating transcripts of all the calls. So when you click on this, theoretically, click on this. There it is. Takes a second. Then it'll pop up a PDF of the quarterly call transcript. If you go here, their CFO is going to talk about the tax rate. So as you scan through the quarterly calls, you just quickly look for tax rate. You can do a quick search of the PDF, and you can find it. If you don't find it in the transcript, the other place you can get it is if you go back to Bloomberg and you type in BRC, which is Bloomberg Research. That's where they're aggregating the analyst reports. So unfortunately, for our base license, we don't really get many analyst reports. You got to pay more for those subscriptions. But we get JP Morgan, and they're a pretty respectable bank. So same thing, JP Morgan is trying to do what we're trying to do. So you can download the JP Morgan analyst report, quickly see what tax rate they're using. All right, so you use your analyst as a proxy. Or I think there's a service on Elms, which gets us analyst reports. You can also use that to get analyst reports to try and find a tax rate. But we need to get a realistic tax rate. Now, I'm going to cheat. Bloomberg enabled something for me that they didn't enable for you, which is a paid feature. Right? It's a cool feature, and it's called Transcript Analyzer. So all those quarterly calls that they're recording, they put into a Google searchable database, and you can search the transcript for any keyword that you want. And you can do it across industry too, which is pretty cool. So for Parker Hannifin, instead of their peers, I'm just going to do it for a single security because I'm going to be lazy. And I'm going to type in the word tax rate. Every mention of the word tax rate is then going to pop up in all the calls, all the transcripts they've done. So Kathy, this is their CFO, basically on the last call, guided to the analysts a pro forma tax rate of 23%. So boom, there it is. Now, this would have been just the extra step. Looking through the PDF, you would have found this, but that's the point. We know that they're guiding the analyst towards 23%. So here's what we're going to do. We're going to come back to Excel. We're going to take the tax rate to 23%, and that is going to change the stock price to 219. Yes, sir. Great question. So do we assume it's 23% every year? That's a judgment we'll need to make. But realistically, and you can see that the tax rate does bounce a little from year to year. It's been as high as 33. It's been as low as 26. So it's within a range. But, I mean, we have to put in a reasonableness test, so what we think is reasonable. Now, without knowing too much, I'm going to say 23 is probably reasonable for Parker Hannifin. But that's the point. When you're doing your valuations, this is the key. It's not just pure plug and play. Like if you see a variable and they say 23 and you think, you know what? No, I think that's too low. Put in 25. Just explain it. Why am I using 25? You should have a basis for that. But for lack of the as is, let's start with the guidance of the CFO. That'll usually help us because most analysts are going to be pretty close to that. All right, good question. All right, next, we need the revenue growth rate and we need the EBITDA, particularly for the next 5 years. Now, here's the thing. I'm be willing to bet most of you don't know a lot about Parker Hannifin. So again, here's where we're going to use the real world. The people that do know a lot about Parker Hannifin are called the sell-side analysts. And the sell-side analysts are creating the same models we are. And they know more about this company than we ever will. And they've taken their models and they've uploaded them to Bloomberg, and that's called the consensus estimate. This EEO, second key screen, is a real-time view of the consensus estimate database. And you will see there's a forecast for 2019, 20, 21, 22 revenue. So this is what I'll call wisdom of the crowd, right? So this is the baseline Wall Street's using for Parker Hannifin. I don't think we're going to do better than that. And when we're doing the as is, I think we should use that. So let's just talk about how they created this. If we look at 2019, basically what happened is of the analysts that are covering Parker Hannifin, 18 of them made guesses for revenue for 2019. They uploaded the guesses to Bloomberg. One was deemed a mathematical outlier and thrown out, but the average of the 18 is 14,783. Okay? The high was 15,014 and the low was 14,608. So they have a relatively tight range, but nonetheless, that's the consensus and that's how it's created. All right? And that was 17 analysts are part of the consensus. For next year, 15 analysts are part of the consensus. 16 uploaded, high 15,524, low 14,975, average 14,214. Notice when we get to 2021, the number of analysts in the consensus drops to 9, and in 2022, it drops to 2. So here's the deal. Bloomberg's a database. It tracks everything that you put in as an analyst. And the worst thing for you is to basically be wrong. So what generally happens, you just see this through observation, is the first 2 years are the most heavily forecasted in Bloomberg. And it's not that the analysts don't have a forecast for year 3, 4, and 5. They do. They just don't want to put themselves out there because if they're really wrong, they're just going to have egg on their face. And that's not good for their careers. So less analysts are willing to publicly give in Bloomberg the out years. So it's not saying that we can't use it, but just recognize that almost all the analysts are predicting the first 2 years. You only have 2 brave souls that are predicting 2022. And I'm not going to say that that's the true consensus. But nonetheless, it's data that we can use. And by the way, if you click on it, you can see who those analysts were. It's the analysts for Stifel and Cowen. Okay, so those were the two. Nathan Jones and Joseph Giordano were the 2 brave souls that were willing to project themselves 4 months out publicly, or 4 years out. But nonetheless, so here's the deal. At a minimum, we're going to use the 2 years. Most of the time, if we see enough forecasts, we're going to use the 3 years. If you think it's reasonable, you can use all 5 years. Okay, you can actually go forward into the future and see if anybody's willing, like one brave soul did a 5-year forecast publicly. But nonetheless, you just change the periods here. But that's the point, at least the next 3 years. Because I don't think we're going to come up with a better forecast than the consensus. And this is really the consensus that's driving the baseline for the valuation anyways. So here's how we're going to do this. I need to get those numbers into my model for growth and EBITDA. So here's how we're going to do this. Back on the Assumptions tab. All right. My first forward year equals 2018 plus 1, it's relative year. That's 2019. Then plus 1, 2019 plus 1, and 2020 plus 1. The next 3 years, 2019, 20, 21. What I need is I need the consensus revenue estimate. I need the consensus EBITDA estimate. And I need the consensus, spell right, change that, EBITDA margin. Because that's what I really need. I need the growth rate and I need the EBITDA margin because that's what we're using in the model to forecast. Because if you go back to the income tab, there's nothing yellow here. So I can't directly change these numbers. Okay, so here's what I'm going to do. I'm going to go back to assumptions. I'm going to make these 6 fields yellow. So for the consensus revenue estimate for 2019, go to Bloomberg. 14,296. So in my model, 14,296. 2020, 14,783. And for 2021 revenue, 15,214. For EBITDA, 2019, oh, 73. Sorry, I put the wrong one in. 14,783 is 2019. Copy 20 is 15,214. And 21 is 15,503. I was off by a column. 15,503. Okay, for EBITDA margin for 2019, EBITDA 19, 2644. For 2020, it's 2795. And 2855 for the third year. And again, I'll format this so it's a little cleaner with commas. All right, so our EBITDA margin is our EBITDA divided by our revenue. So basically what they're saying, and again, I'll format this as a percent to 1 decimal place. That's the EBITDA margin for the next 3 years, 17.9, 18.4, and 18.4, based on the consensus, hidden in plain sight. Everybody see how I got that? Questions about those numbers? Okay, so here's the thing. I need, in my income tab, these 3 forecasts to equal these, but I can't change it directly. And the way I change it is I change it on the ratios. So here's what I'm going to do for 19, 20, and 21. Starting with 19 equals current year minus previous year divided by previous year's percent change. That's the formula for percent change. So equals left paren current year 2019, cell B15 off the assumptions, minus previous year, income tab, actual revenue in 18. G3, right paren, divided by G3. That's my percentage change, 3.4%. In fact, if I put in the 3.4%, I get 14,783 in my model. I'm going to do this again. So for 2020, okay, want to match that. So here, equals left paren, current year, minus previous year divided by previous year. 2.9% for 2021. Current year minus previous year divided by previous year. So for the next 3 years, and I'm going to get rid of the yellow, those are the growth rates that the market's using to basically get those revenue targets. Now, by the way, I could have been lazy and I could have just gone to Bloomberg and switched to the growth tab and I would have seen 3.4, 2.9, 1.9, okay, what we just solved for. But I just want to be more granular and I'm going to basically back solve for those three numbers. But that's basically what we just did. We just solved for the revenue targets and the growth rates that got us the ones in the model. Now, same thing for EBITDA margin. So to match the EBITDAs for these 3 years, rather than using just random numbers, EBITDA margin in 2019 based on consensus is right here, B17. For 2020 is right here, C17. And then copy D17. So you can see that they're forecasting EBITDA margin to go from 16% last year to 17.9 to 18.4. And by the way, if you look historically, that's the best it's ever been last 6 years. So a lot of potential improvements in their EBITDA margin. By the way, share price, $103. And we got to get to 185. All right, so let's think about our drivers. What can we change? All right, we can change the growth rate. We could change the EBITDA margin. We could change the tax rate. We could change the G. And we could change the WACC. Those are really the 5 things that we can change to get close to those 2. Okay, so let's just start out and say tax rate. You think the tax rate is going to be dramatically lower than 23% going forward? Because we need to lower it to get a higher share price. And given that the corporate tax rate is 21, I just don't see it being dramatically lower, especially because they've never done below, you look at below this, less than about 26%. So I don't see it going below 23. Okay, so I don't think that's going to be a big driver. All right, margins. You think they're going to get better than 18.4% margins into the future, considering 18.4 is the best they've ever done? Like cranking that up to 20, 22%, that seems a little bit aggressive. I'm not saying we can't do that, but probably not that. So that leaves me with growth rate, right? What if they start growing a little bit faster? What if they can grow at 5% a year? By the way, 5% gets me to $113 a share. That's $3 a share. So something is amiss. Like getting that growth rate, I mean, we're going to have to crank that growth rate up pretty dramatically to get another $80 a share. And remember, this is not whether we agree with it. This is trying to explain what the market's using. So what we stumbled across in the last class is normally, I would say, leave the WACC alone, right? But just so happens that I'm working with Parker Hannifin, and their CFO, Kathy, who you can see her on the screen here, has basically been talking to the analysts to try and convince them that the WACC should be closer to 8. Okay, that's just the guidance that she's trying to give the analysts, that 8's probably a more reasonable WACC than Bloomberg's 10. Okay, so just out of curiosity, if we were to take the company believing that their long-term WACC is lower than what Bloomberg's using and put in 8, $186 a share in our model, $186 a share trading today. So here's the deal. If I had to guess, and this is the part of valuation that matters. This is why we do the as is, right? Because this is not about whether we agree with it. I could disagree. As a matter of fact, if I looking superficially at this data, I'm probably not putting them in the buy. I'm more likely to be on the sell side. Because to put the numbers in to get this price, to cut the WACC that much, that's pretty dramatic. Okay, but nonetheless, I got to explain the share price. And changing everything else is not going to change it enough to give me $80 a share. You can play around with this. You can iterate. And we really need to change the WACC. Now let's talk about what drives WACC. If I go back to the WACC screen, here's what's interesting. This is WACC. And this, if you click on this, is the CAPM Bloomberg's actually using for the WACC. So it's really cost of equity because 80% of their WACC is equity. So here's the deal. They're using the 10-year risk-free rate, which right now is 3%, 3.15%. I don't think that's an unreasonable assumption. They're using a risk premium for the U.S. of 6.8%. Now, Chicago says over 80 years, it's been between 5 and 7, depending on what time frame you look at. So whatever it is, 6.8, a little high, but I don't think it's an unreasonable risk premium for the U.S. market and the S&P 500. So really what's hurting them is their beta, 1.34. They got a pretty high beta. So if you really think about this, what would cause the cost of equity and the WACC to be lower, you can play around with this, is that I would basically need to change the beta to 1 update this and see that that gets me a whack closer to 8. So if I really think about what's happening to Parker Hannifin, I'd have to say, okay, what's driving beta? What's driving beta is this is a cyclical business that's had a lot of volatility in their stock price over the last 2 years. So let's go back. You guys did an EIC, RV, and let's look at the industry beta. So if I look at the industry beta, when you did EIC, the industry beta is 1.3, and they're at 1.5 raw, but even unadjusted, 1.2 and 1.34. By the way, if I did a 5-year beta, which I did earlier today, it doesn't change all that much. So what's interesting is that to get to the 8% whack, what we really have to convince the market is that we're a lot less cyclical going forward than what we've been in the past. And we're a lot more predictable than what we've been in the past. Okay? I'm not saying it's right or wrong, but I'm saying that that is probably the biggest explanation of their share price. And this is why we do as is, because I really want to know what the market is actually believing. Now, here's what's interesting. If you were to go to the actual analysts, the sell-siders that are doing the same thing we are, 12 buys, 10 holds, 1 sell. If you look at their target prices, they're at 190 as an aggregate. But here's what's interesting. Several of these analysts, 165, 165. Okay? They're lower. Here's some share prices. Scroll down. 170. So it's interesting that I'd be willing to bet that the holds that have the lower share prices are probably the ones that are using the 10% whack. And the buys that are aggressive are the ones that are using closer to the 8% whack. Because that's really the difference. Because you can actually play with this. You can change revenue growth rate plus or minus 1%. You can see what the impact of share price is. You can change the margin plus or minus 1%. You can see what the share price impact is. And what we just showed is a couple of points of revenue growth are not going to drive $80 worth of share price. It really would have to be whack to have that dramatic a difference, given the numbers that we just forecast. So this is where you get a feel for your buy, sell, hold, and your target stock price. We're not doing that here today, but nonetheless, as I said, for me, I'm going to think that they're probably more than fairly priced. In fact, I think there's probably more downside risk than upside risk at this price, given these numbers, unless the market really just believes that that's the right whack going forward. It's also be interesting to pull up a couple analyst reports. Pull up the JP Morgan analyst report, see what whack they're using, see if the analysts are actually buying into this. So again, this is what we'll get into, some nuances of the valuation, but for purposes of today, if you got to here and you got to what I did and you put in these numbers and you're within $1 of the share price, you've completed homework 6. And this is the file that you have to upload between now and 10 a.m. Monday morning. Yes, sir. I'm sorry? For homework 6, I don't need the screenshots. I just need you to upload your Excel file individually, no sharing of files, that gets close. Now, if you put in slightly different numbers, so you have a slightly different growth rate, slightly different margin, but you're still within $1, you're good. Because what I really needed you to do for homework 6 is to basically finish the model and, more importantly, understand the types of assumptions that we can change that will ultimately affect the valuation and start having appreciation for the as-is process. So as I said, if you got to where I did, you're done with homework 6. If not, this is being recorded. You can follow along on the recording. Get there individually by Monday, 10 a.m. Questions? Yes?
Is it okay if we have like some additional notes to ourselves?
That's okay. Put in whatever notes you need, because this is your model. Like, you've built your own model that you're going to use for future assignments, including the one next week. So hold on. Need your attention for about 4 more minutes. So your next assignment after homework 6 is group project 2. And group project 2 is due 10 a.m. Wednesday, October 10th, 1 week from today, for all sections. All right? And here's what group project 2 is going to involve. I put it up this morning. Boeing. You're going to do an as-is valuation using this model and this process within $1 of Boeing. And you're going to explain your assumptions that you used to get there. In addition, you're going to do an EIC analysis and write-up of Boeing using operating ROIC to calculate industry spread. and you're going to turn that in as part of your group project. You're also going to do an ROIC tree analysis, 5 years of Boeing, which you're going to write up and turn in. Now you're turning this in as a group, not individually, and the 3 combined need to be in a Word document, minimum 750 words. Okay, less than 750 words, 0 credit for the entire group. And remember that one of your group members must turn this in by 10 a.m. next Wednesday. And we're going to discuss this in class next Wednesday. Boeing. It'll be Boeing Day. We're going to talk about all 3 parts. So in a sense, you've already done 2 of the homework assignments. We're just repeating them for Boeing, EIC and the tree. And then what we just did for Parker, you're going to do for Boeing. Okay? Yes? So to help you have time, I'm going to give you Monday, there will be no lecture. So you have the time in the lab to work as a group to get the data that you need. Because obviously it's a lot of Bloomberg data. So there is no lecture on Monday. You just have Bloomberg time. But there will be a lecture on Wednesday, and we're going to discuss all of this in class on Wednesday, and you'll turn this in as a group, not as individual. So homework 6, you need to turn into Parker Hannafin valuation as is before Monday. And then one of your group members, because I'm not going to post the solution, one of your group members who believes they have the model down the best, you're going to use that file to do the Boeing assignment. So a couple of tips when you do that. So first thing, to do the valuation model for Boeing, you'll go to BA, US Equity. One of your team members that did the model assignment correctly will go to FA. Because if you did it incorrectly, bad for your team. You'll go to Custom. That model assignment that you just turned in, you'll go to your model and make sure 6 years of clean data, no other crap. Okay? And then basically export Excel current template. Very important. Once you export this data to Excel, you got to get rid of these dashes. Because when you use these dashes, it's going to kill your model. So again, the person that exports, find the dashes. Find. Simplest way to do this is to copy the dashes, then do find, or replace is even better. Paste in the long dash, because I heard somebody in the last class that actually just put in a short dash and it turned all the negatives positive. So you don't want to do that. Okay, so basically find that long dash, replace with 0, replace all. So 38 replacements to get your Boeing data. Okay, save it somewhere where you can find it. So this is my Boeing data, and I will put this in my downloads folder. But once you do, then select it, copy it, go to the Parker Hannafin model that we just did. Go to the Model Data tab, select it, right-click. I didn't copy it, but copy it, paste special values. That'll overwrite. Don't paste, because it will then look at a reference to the other spreadsheet. Paste special values, overwrite this whole tab with the Boeing data. But you're not done yet, because then, assumptions. Make sure you put in Boeing's WACC. Make sure you put in Boeing shares outstanding. Make sure you're referring to Boeing's share price, not Parker Hannafin. Otherwise, you'll be very frustrated trying to redo the assignment. All right. Once you've done all that, second you type in the data, over here, there's a tab called ROIC drivers. That's the tree. The second you paste the data in, it creates the tree automatically. So the Boeing tree will then be here. You could then print out the Boeing tree for your analysis, which you're going to have to submit. Okay. And then finally, you're going to need the 3 screenshots. So again, in the Parker Hannafin folder, these are your 3 roadmap screenshots. DES gets you your share count and the current price of Boeing at the time of your valuation, because obviously you might be doing it on different times, different days. So to get within the dollar, we need to be at dollar as the time you do the DES screenshot. EEO is the earnings estimates for revenue and EBITDA. And the WACC is going to be the WACC. And I don't think you're going to have the problem with Boeing's WACC that we have Parker Hannafin's WACC. Just a guess, right, as you go through the assignment. But again, that's the assignment. You'll turn it as a group. All those files, it's listed on there as a group by Wednesday, 10 a.m. Yes?
I have a question about the ratios page.
Which page?
The ratios page.
the ratios page. Okay.
So when I was changing the cost of the revenue growth rate,
Mm-hmm.
and I was for 2019 through 2021, my projected one for 2022, 23, and 24 also seems to be 1.9%.
Yeah, because what we've done here, and I overwrote, so that's a good point, is I overwrote the equals the previous year with a 5.
Okay.
But you actually brought up a really good point, which is because I've hard-coded a 5 in here, then if I replace this model, Boeing's growing at 5% in 2022, 23, and 24, because now this is hard-coded. So that's the other thing to watch out for when you use a model. Because same thing, Boeing's going to have a 23% hard-coded tax rate unless I change it. So when you reuse the model, just recognize that data that was previously in there is going to be lingering in there. And one of your sources of frustration that she brought up is you might get a really weird share price, and it could be based on Parker Hannifin's EBITDA margin, which is going to be different than Boeing's EBITDA margin. So again, just recognize these things that when you hard code will actually carry over, and you'll have to make sure you update. That's why I look at the cells in yellow, and I tried to minimize the cells in yellow that we changed, and to some degree they're highlighted in light gray. Right? You can muck around with more, but I'm just telling you this is the 90-10 rule of what you're going to get the real valuation on. So make sure when you write up your assumptions, growth rate, EBITDA margin, tax rate, G, and WACC, those are the 5 most important things. Yes?
For the ROIC tree, do you want us to do each year or beginning to end?
Ideally, minimum, I'll put it this way, minimum beginning to end.
Okay.
But if you can start doing the intermediate year, all the better. Because to be honest with you, this is a dry run of your group project that's due at the end of the semester. It really is. Because these are 3 of the 4 things you're going to have to do for your major group project. So it's just good practice more than anything else. All right? So the more that you practice doing it the right way, the better off you are as a team. Obviously, you're turning this in as a team assignment. All right. Any other questions? Okay, so again, no lecture on Monday. You have time to work on in Bloomberg in the classroom. Our next lecture will be Wednesday, and will basically be Boeing Day. We'll be debriefing all of this. I'm not posting, those video posted, I'm not posting the model. So you would have had to create this model to do the Boeing assignment as well as today's assignment. Today was individual. One of you will use your model for the group for next week. Hopefully you got that one right. Okay, good luck. See everybody in a week.